Hello, everybody.
How are you?
Not too bad.
Hello.
Yourself? Mr. Ben's on the call. See Mr. Chris, Mr. Ricardo. All right.
My camera doesn't work. Well, I got to get an auxiliary camera if I'm going to show anything.
That's okay.
Underneath, it's on the laptop.
Okay, cool. Hey, Jake. Awesome. Well, yeah, we'll just give 1 or 2 minutes here for people to join up, and then we'll get rolling here. I don't really have any, I guess, like diagrams or anything really fun to look at. It's kind of just like a talk through, but I can try to put some stuff together here. Basically, I'm working on a write up for Seeking Alpha, like an article on it, and I'm probably halfway through, but I don't have any good like charts or anything fun. Hey, Peter. So yeah, I mean, hopefully when you guys ask questions and things, I can answer them. I am transcribing this, so hopefully you can get some notes and things. I can send it out to the team here. But yeah, we'll just give it a minute.
Yeah, Gaines. I mean, when I was researching this all through this week and last, I mean, there is a ton of information out there on YouTube with great diagrams and strategies, and you can get lost in it. So,
yeah. So I kind of thought
typing anything up, but there's just tons of information out there for you.
Yeah, I kind of thought it would be, we're trying to keep it like the 101 sort of level, but like, a bit of a step down too. I mean, I think you guys are at least savvy enough where you at least like understand, terminology and things like that. So and if anything doesn't sound right, please stop me. I have a tendency to talk fast. So, but I got an outline this time, Chris. So don't worry. Hopefully I'm not going to be meandering around. You guys got to keep me on task here. But yeah, so anyways, I thought I would do just a quick, like, top level down here about kind of like how it works and, really kind of dive into the strategy itself. And I also have a couple of books and things that, I could share, we could talk through. So, yeah, it's actually kind of a good day, I think, because market's just like in molasses mode, I guess. So we can talk about that another time, but for now, all right. So who has, I'd say, like, does anybody have any good options knowledge, or like have been trading with them before at all, or?
Not really. I've done some, but nothing particularly sophisticated. Really, just like directional long calls, long puts, maybe a call and put, but yeah, nothing quite like what we're doing here.
Okay, cool. So that's good to know. So again, starting from the basics here. So options themselves can be scary, but it's really just, you got to know what the terminology is. Okay, like I won't go into the details about like the Greeks and things like that. There's only a couple really that I think you should be well aware of that I think they're the most important ones. Delta really is, it goes between 1 and -1, which is essentially, it's like if you buy a put, you have negative delta. So if the price decreases, then that's at least, like, let's say you have 0.5 delta on your put or 0.5 on your call, that kind of thing. Excuse me, 0.5 on your call and -0.5 on your put. That just means that for every dollar that the price moves, your options contract will increase or decrease in value by 50 cents. Now, as your option gets more out of the money, so there's a couple of other terms too, and I'll go through some of the some of the Greeks here, probably like 3. But there's like out of the money, which is, let's say you buy a call that's at 90 and the price is at 100, that kind of thing. That's out of the money. In the money means that, let's say you bought a call at 100 and the price is now at 110. You're now in the money with that call option. And at the money is really just, price is at 100. You have a option at 100, that kind of thing. So that's really kind of like the basic terminology, at least like when people talk about in the money, out of the money. I haven't really heard, other terms to be used for that, but for the most part, that's pretty much it. Kind of back to the Greeks thing. So Greeks and understanding, in the money, out of the money, all of that. Think about it like, let me think what a good analogy is, where it's like anytime you move. So let's say football game, right? So you got the ball at the 50-yard line. Anytime you move closer to the other end zone, if you want to kick a field goal, there's different strategies. Okay, so like if you're, let's say, 30 yards from the goal line here, there's different strategies where you might want to run and or pass. That just determines like your different option strategy. But for covered calls and for for cash secured puts, it's really just pretty basic. So we won't go into any of the crazy option strategies. Spreads aren't that hard to understand, but that's like a next level. I think we won't touch on that today. But again, so the terminology is important. You might want to take a look online and see if you can find anything. Like Chris said, there's a ton of information out there. I agree, there is a ton. Try not to get swamped by it. Again, I will have a write up on this, and hopefully it's going to be simple, or hopefully it's relatively easy to understand. So out of the money, in the money, Greeks, those are really the pieces that you'll hear a lot about. So we already went over delta. There's another one that is really big. It's theta. So theta really is just time. It's just time premium. So what's working for us here? So options themselves, you control essentially 100 shares of whatever you have an option on. So if you let's say you buy 100 shares of SPY, you can buy one call option or for 100 shares of SPY, and that pretty much mimics the leverage that's associated with it, without having to buy actually 100 shares of SPY. I mean, that would be pretty expensive, right? So, but that's still like the fundamental premise of selling puts is accumulating shares at prices you want. But we'll get to that in a second. So when you sell an option or you buy an option, you have like the clock starts ticking. So you have intrinsic value and extrinsic value. And what that typically means is if you buy an option that's in the money, so let's say the price is at 100, you buy an option at call option at 110. That's like 90. So you're $10 in the money here. That's a very expensive option. So you have some intrinsic value, which is that $10 difference that you have between what you bought the strike price at and the actual the money line, which is at that 100 price. So what happens with that is when you typically, I guess when you buy an expensive option, it's like you get a lot of decay on the time frame, and it also accelerates as you get closer to the expiration date. So what people typically make mistakes about when they first start trading options is they don't give themselves enough time. So they'll do 2 or 3 days on an option, and if the price goes a different way than you're expecting, then you could actually have a bad problem because your time premium, your decay is so fast on these options that you don't really have any opportunity to recover it. Even though you might have been right, you still just didn't give yourself enough time. So for example, let's say you bought some calls on a stock and a stock that's declining, that kind of thing, you're thinking it's going to pivot in the next day or two. Let's say you're wrong and it doesn't. So the price keeps going down and down and down, which we've all seen before, and probably swore at your computer a couple times. But you have options, right? So no pun intended. You can add extra options and increase your delta. You can roll out your options. So I'll be covering that in a second here, but and I want to make sure I get through this stepped approach here. So your options themselves, you have this time decay that's associated with it. It really accelerates when you have about 2 weeks until your options are about to expire. So it's like a logarithmic sort of curve. So you'll have this. So if you buy something that's, let's say, 30 to 45 days out, you'll have a much easier time of that theta decay. Now, there's also different things that impact options pricing. It's called the Black-Scholes equation. It's a very complicated mess of numbers and symbols and signs and stuff. We don't really need to know that. All we really need to know is how to understand what the numbers mean when we're looking at options chains. So I guess now that we kind of covered delta and theta, I think really the only let's just stick with the top two. I'd say for now, because that's pretty much the only thing that we're really going to be focusing on when we're doing covered calls and cash secured puts is how much money can we make in theta, and which is time decay, which is your extrinsic value. And I'm sorry, I don't feel like I finished the thought on that one before. Your intrinsic value is that delta that you have if you're in the money. So you buy a call at 90, price is at 100. That 10 points there, that is your intrinsic value. Your extrinsic value is the time that you're buying on top of that. So that's the time you're giving yourself or the time that you're selling somebody in order for that play to work for them. There's a statistic somewhere that 75% of all options expire worthless. I don't know how true that is today, but I would think it's probably pretty true. Option sellers, you typically have control of the market itself, where you can choose the different time horizons that you're selling. Oh, sorry, implied volatility. Yes, we definitely want to talk about that. Let me. Sorry, Chris, am I getting off track? Sorry. Hold on. I have an outline here.
I have one quick question. Maybe.
Yes.
Oh, sorry, go ahead, Chris.
What was that? No, somebody.
Oh, okay. Well, regarding the time value, if you do have a shorter dated option, is it generally true that they don't have as much time value remaining? So like, well, what you're saying is true. Like what time value is there will decay very rapidly. Generally, that number should be fairly small to begin with like obviously the shorter or the less time to expiry that there is.
Yes. So it just accelerates the closer you get to your time horizon. And that a lot of that is driven by what's called implied volatility, or IV. So I'm sorry, I misspoke. Really, three of the Greeks that we're really concerned with. IV, implied volatility. I believe it has another name, but most people just call it IV or implied volatility. Most options change, you'll see IV. So delta, we've talked about. Delta is really just the speed of the move. So if price goes down 10 points, your delta is 0.5. That just means that your option doesn't make you $10. It makes you $5 instead of the 10. So if you own the stock is 1 for 1. $1 higher equals $1 more in your pocket. But an option at 50 delta or 0.5 delta, that's half of that in your pocket with that. And delta increases over time too. So delta is important because it impacts the value of your option just like everything else. That's why it's a chain, right? So the closer you get to in the money, the more expensive it's going to be because you're already buying. You're buying a higher delta, I guess you could say. So what really experienced put sellers do is they will pick a stock that's been declining. Let's say it's at the 52-week low, something like that, and then they'll sell it they'll sell a put option a little bit higher up because they're expecting a bounce. So it has a high delta, and what that does is when that depreciates over time, they'll make a lot more time premium. But it comes at a higher risk, I guess you could say. So again, there's different strategies. I won't really go into all of them here today, but just saying that I just wanted to kind of focus some time here and talk about the Greeks and how they're kind of interrelated and how they work. So delta being the speed of the move, in anything that you buy that's closer to where the price is trading at today is going to be more expensive, or lower for a call, higher if it's a put, that kind of thing. In the past, let's say, SPY was at 400, something like that. Let's say it looked like it was topping. You could buy a 410 SPY put, something like that, which would be, let's say, $2,000 a put as opposed to 600 at the money. But you're paying for more of that implied volatility. You're paying for more of that delta. And let's say you're right, and it goes down to 390, something like that. So you've captured a 10-point move, but your delta is probably 0.8. So even though it was more expensive, you made a lot more money on that 10-point move down as opposed to buying an option that's right at the money. There's a lot of people that do out of the money calls and puts. I like to call those lottery tickets because there's usually a little box or a little metric that your broker will calculate for you that says what's your probability of profit. I think it gets a little squishy once it, between that 40 to 60% profit range, because that's just general volatility in the market. It gets a little bit more predictable when the market is moving very slow. But when the market is moving up and down pretty quickly, it's best to just kind of, take a step back when you're talking about buying options. You can have that allure of a ton of money coming your way, but you have to pick the right direction, and you also have to pick the right amount of time that you want to buy. So again, I can't really give advice, but the one thing that I've noticed over time is that if you give yourself at least 30 to 45 days, you might not get all of the money that you could if you made the same play, but you gave yourself, let's say, 15 days or 30 days, but it's safer. It's safer because you're essentially buying yourself more time in order for your play to work. So, again, back to the football analogy, it's like you're at the 30-yard line. Do you pass or do you run or do you kick a field goal kind of thing? Well, that depends. Like, is the market 3 standard deviations higher than, or is it at the peak of something like that, or is it right in the middle, consolidating? These are the things you need to think about with all this. But again, circling around to cash secured puts and covered calls, you don't really need to worry about that so much. It's more about longer term. What do you think, or like what do you think is going to happen to that stock? And you think about it a little bit differently. It's not about how high is the stock going to go. It's more about what weeks have higher volatility than others. And I know, like, for example, for E-Trade, you can it's called the volatility constellation or something weird. But what happens with that is you can pick the different, it'll show you a graph, and I'm not sure, I think maybe Thinkorswim has it too. But it'll show you like a little graph that where 1 week or something has higher implied volatility than another, and that might just be because it's expiration date for that month, something like that. Operations expiration. People think that there's a lot of volatility around those days. I don't really see it, to be honest, especially when there's a lot of gamma. Gamma really is just the amount of options at a certain strike price. So you hear things like gamma, vega, rho, like all those Greek names and stuff like that. Really, all you need to worry about is really just delta, theta, and implied volatility when we're talking about cash secured puts and calls and stuff. So I'll stop there. Does that make sense? Am I talking too fast? Am I meandering around? I want to make sure this is valuable for you guys.
Definitely makes sense.
One thing, Gaines, that you'll probably mention on here too, but if you're going to trade options, you're going to need some type of a tool to actually be able to project. It puts everything that Gaines is explaining in perspective. I use Option Strat. I can't tell you how valuable this is. It's $20 a month, and it's option like it's spelled STRAT. And once you do a free trial for 2 weeks, just to get your feel of it. But not only does it offer all you track your trades, it shows you how much you can win, your lose, your stops, everything. But it also is educational. It shows you every type of trade and gives you illustrations in a much better format. I don't know if you guys use Fidelity or Broker or Thinkorswim, but the tools that they provide to do this are very, very hard to understand.
Yeah, and they suck.
I'm telling you, Option Strat, and I've tried a dozen of them, and I narrowed it down to this one. Samurai's really good too, but Option Strat by far. Check it out if you're even thinking of this. It'll make your life a lot easier. Really. Yeah,
I agree with Chris. Option Strat's pretty good. I've just kind of been fooling around with it. I've been using E-Trade, just power trade, for years and years now, so I'm very familiar with it. If you do have E-Trade, something like that, they do have like a risk, like a modeling sort of tab that you can click on with options. So you can type in, like a strike, or sorry, it's called Trade Lab. So, I don't know if any of you guys have E-Trade or whatever, but, feel free to reach out. I can give you some tips on like how to model some of that stuff out. As long as it's not like buy here, sell here, I can't say that. but if you're going to do some modeling and stuff, that's, it's totally fine. That's just education. So, I have no problem with answering questions and things like that. Because honestly, guys, like, options are hard if you're not doing it every day, and especially when you're first trying to learn them. The last thing I want is you guys to lose money and just because there's a knowledge gap, right? So I wouldn't be doing my job if I didn't offer at least some sort of help, feel free to send me a DM or something if you don't understand something, or post something in discussion. People will chime in, and hopefully we can all figure it out. So yes, like Chris said, having a good software works will definitely give you an edge with that, because you want to because we already touched on a couple things, right? Like, I think options chains are pretty difficult to understand, not just because it's just a ton of information and numbers and stuff. Like, numbers, people don't really have an issue with that. It's just where you click, when you click. Like, it's just, at least E-Trade's really weird. I don't like it. What I do like, though, is I have, don't make fun of me, I have a Robinhood account, and there's a reason for that, because I think Robinhood actually has the cleanest options chains out there, and it's the most easy to understand. It's easy for you to, like, for example, the calls we sold yesterday, I have those all pinned now in my Robinhood account, so I can see what those values are. So at the end of the day, when I update the spreadsheet, I can be able to tell just right away, instead of having to go like through E-Trade, through the dashboard, like 17 different clicks just to get to each ending option. Anyway, so the I guess the summary for that is, like, find a good tool for it, get good with the tool. We won't talk about like books and stuff quite yet, just because I feel like that the premise of it is simple as we get to that here, which I'm going to talk about in a second. So that's really just like a crash course on the Greeks, and a crash course of, like, just to kind of let you know that they're all interrelated and it's all part of one equation. And you think about it like you take from one side, it adds to the other, and so on and so forth. So it's like this constantly rebalancing sort of thing. And you'll also start to pick up on some of the different tricks that you can do. And I will have some of these written up for you guys in the future. Tricks like, you want to sell options on a day where you have high volatility. So like the VIX, let's say the VIX goes up 15%. You're like, yeah, man, sell yourself some calls that day. And if volatility goes down and you start to see prices move up again, well, you can capture a lot of that extrinsic value through the decay of time, but that's just through like the macro lens, if that makes sense. It's like, you could sell an option for $1,000 today if the VIX is up for 15%, or you could have sold it yesterday, let's say for $700 when the VIX was 15, or if it just didn't really move. So it kind of depends on volatility. So keep your eye on the VIX. I think it's actually a little easier to sell puts when the VIX is high, because people typically pile onto puts, and you'll notice that there's an imbalance between calls and puts. You can also tell if the market is heavily geared towards calls, or puts if the premium is a lot higher. So what I've noticed over the last couple of months here is that buying calls, they're about 30% more expensive than puts are. And that's just because, the dealers need to hedge their risk, and they need to, command time premium and stuff to, in order for them to take on that hedge of puts and things like that. So the long story short of it is, when the market goes down, the VIX goes up pretty quickly, and you can either buy volatility, or, which can be kind of a crapshoot, or you can sell puts on stocks that you want at a decent price. So, I've been asked a couple of questions about like the quantum stocks, like, if they're going to decline some more, why do we buy in? Well, the answer is like, well, we're not really sure if it's going to decline much more or if it's going to keep going up. But, we had a good day yesterday, and I see, they're within a couple percent of where they were yesterday. So all we're really trying to do is just capture the big bulk of the move, because we've sold these calls 3 weeks out, and we have 3 weeks now for it to either consolidate and burn that time premium for whoever bought those calls. But again, if the price keeps going up and up, then we just limit our future returns, and we can always roll out those options and things. And I can talk about that in a future. I guess like I want to try to keep it simple by not going down the path of like what happens if this happens. I'm trying to really more focus on like why are we doing it, and what's the advantage of it, what's the risk, that kind of thing, and just kind of give you guys some background on why it's a relatively safe strategy and why it's something that a lot of people do for like income generation, for example. So in another time period or in another time, we can talk about the different options that we have. Again, no pun intended, but down the line here, if we have to buy something back, let's say price goes way higher than we ever thought it would. Now what do we do? That kind of thing. Or if let's say a put gets assigned, just stuff like that we can go through in the channel. And I can host other webinars and stuff. Okay, so we'll start out with cash secured puts. I think that's probably the easiest because think about it like you got a clean slate. All right, so pick your favorite stock. Let's say Apple. Okay, so Apple at 100. Let's say it's trading right at 100, and you think that it's going to go down to 90, or you think that 95, you'd be okay with paying $95 a share. So what you can do is you can sell a put. So let's just say you want to sell one put. Okay, if it's trading at 100, it costs you like $10,000 in real stock to buy it. But selling a put is just like buying the real stock, only you don't really own it. But what you're getting is compensation for giving somebody the opportunity to buy that at, let's say, 95, something like that. What you're doing is you're getting that time premium as your cash is tied up. So I'll say it like, so you want to buy a stock at, let's say you sell the strike at 95. And what you do is, let's say it gives you $2,000 in premium for 2 weeks for selling that put. If the price declines to 90, well, you might get your put exercised and you have to buy shares at 95. That's the risk. But that doesn't necessarily mean that, it's all over for you, right? So let's say you went in there easy and you didn't go in full, whole hog half your account. Let's say you got $100,000 account and you had that, that one put that you sold that was $10,000 worth of cash, or let's say $9,500 because that's your strike. What you can do is, let's say after that 2 weeks has ended, and let's say it ended right at 95. So your put wasn't exercised. Everything worked out the way you wanted it. And basically how this kind of works out is you get to keep that time premium. So let's say you buy back your put that you sold, let's say a day or two before it expires. Typically the rule that I like to use is, if you were able to capture 80% of whatever time premium that you sold, close it, because you can always reset it. And you can always, like, for example, the puts that we sold yesterday, the puts that we sold a couple days ago, if they were exercised, that would have doubled my position, which is not good. But you wanted to start out with selling the puts first. And what you could do is you get all that time premium, but then we went up, and I thought, okay, we're right at this wave 4 top. So let's buy back the puts. Let's pocket the $2,100, and then we can sell calls like we did yesterday. And let's say the price goes down 10% or something like that, and those call options decrease in value. Well, we're just recreating the wheel here, and it is called the wheel strategy, where you sell puts. And if they get assigned, then you write calls against it. And if your calls get called away and your shares get called away, that kind of thing, you just resell the put. So really what you're doing is you're just loaning out your money. You're like giving a loan at a really high interest rate, I guess is another way to say it. So I want to stop there because I want to make sure that I'm covering this well. If people are struggling to understand it, there's no bad questions. Maybe just my brain's defective at explaining things sometimes. So please just let me know. Questions, comments? Okay. So to recap, what you're trying to do here is you're selling a put on a stock that you want to buy, that you would be okay with buying at a certain price. And if the price declines, let's say 50%, that's not good. So you'll probably want to actively manage that and buy that back before you end up buying a stock that you don't want at 95 when it's at 50, kind of thing. So there's exit strategies that you should be aware of. There's really just a handful, really like 2, to be honest. What I like to do when I sell options is I like to set like a limit order. Or like a, stop limit, anything really that'll close that trade for you when you're not by your computer. Typically what I like to do with that is when it goes to break even on calls, and maybe like 10% above with calls. You want to give yourself a little bit of flexibility, but what you're really trying to do is block yourself from getting assigned shares at a really high price when you sell a put. So again, like let's say that the stock has really bad news, you sold some puts on it and you didn't expect it. Well, if you set yourself an order to buy it back at break even, you're just going to give your premium back, and then you're not obligated to buy the stock at 95, using Apple as that example. So really just buying it back. That's the exit strategy. That's numero uno. Number 2 is if you get caught, really flat-footed and you're not really sure what to do about it, you can always roll it. So what I mean by rolling it, it's called rolling up and out or rolling down and out, where there's always a little roll button or trade button or something like that on your options contracts when you're in your broker, your browser. At least most of them have it, where where what you're doing is you're closing out your current contract and you're picking a different strike and a different time horizon out in the future. So for example, this actually happened to me when I was trading AMC way back, in its meme stock days, where I had a whole bunch of shares at $7 a share or whatever. I think I had like 700 or whatever. So I had 7 calls. Well, it ended up going up to like, $13 a share in a day. So my calls essentially, because I sold them at let's say $8 or whatever the strike was, that's all the money that I could make was just $8 a share because of the call that you sell. So it might be a little difficult to understand at this time, but think about them running in parallel together. Your option value increases as the delta increases, but if you own the stock 1 for 1, you're always going to make more money right before it takes off. So if you close your option out, you're not going to miss out on really, really high returns if the stock goes crazy. You just have to buy it back. Now, if you miss it, what you can do is you can roll it out. So let's say the next day the stock price is at 13 for AMC. You can buy back your old contract, which would be relatively expensive, but you'll sell a new contract at a new strike, let's say 13, 2 weeks later than the one that you already had. That'll give you more time premium. So it kind of like softens the blow a little bit of having to buy back your old contract. Then it kind of resets your shares. So I shouldn't say that. You buy back the old contract that you sold at, with the $8 strike. Now that you sold one at 13, you get those 5 extra points of profits with your stock. And then you also get the credit for the time premium that you sold on the new call. So pretty much, I guess, to summarize it, it's like the exit strategies are different for whether you sell a call or you sell a put. But all of them really kind of come back to, if the stock is not doing what you want, buy it back, give the premium back, and reset later. I think it's a lot easier to just keep it super basic and don't overcomplicate it. Because some things happen right in the market. Things just go bananas one day and you don't know why. And you're kind of left to pick up the portfolio pieces afterward, like yesterday. So anyways, yeah, shit happens, right? So selling puts and calls and stuff, really just capturing that time premium is the benefit. But just knowing when to exit is the risk management part. So now let's talk like time horizon. So I picked February 7th for those options, because I think that we're not quite done with messing around where we're at right now with the quantum stocks. They're kind of they're trying to find some flooring, but we also made that 50% on that put trade 2 days ago, and now that we're selling the calls on it, I think it was almost like 4,000 something in premium. So like the long story short about it is, this is now the second time we're using the same strike, not strike, the same Well, yeah, some of them strikes, using the same strikes in the same time period for expiration. It's called hitting a double if we actually profit from the second leg. There's been times before, I think I was trading like Tilray stock where I had like, I hit a triple on it because it was like the price shot up one day. I sold a bunch of calls. Next day it went down, and then repeat like 3 days in a row. So like you sell the calls when it's high, you buy them back when it's low. Then when the price it shoots back up again, sell the calls again. So that's kind of the strategy with that. So you really want to try to target stocks though that they have at least 1 million shares traded a day. Sorry, before I switch into the so we kind of talked about like how the options like how the Greeks work with like kind of how it affects valuation. I don't really want to go into like where's a good place for like strategy to buy and sell these sort of things. I think that'll come over time. Really, again, we're just trying to focus on the basics. Then also try to I also tried to step through like how they work, like when you sell them and then when you buy them back. But yeah, I just wanted to stop there and see if it's all making sense, or at least enough sense. Are you sure? We're never coming back once the train leaves the station. Okay. So what makes it a successful strategy, I think, is you can buy and sell time to people. Or sorry, like by selling time to people, they now get to worry about the time, and you're collecting money as you sleep. And it's a signature style of like what Warren Buffett used to do it with the billions of dollars in the insurance company that they were running, where they would buy stock of all of these great companies that they knew that they're going to go up over time, but they can sell calls against it. So they're making they're kind of double dipping on returns. So now there's another so now we can kind of talk like some strategy a little bit with it. Like some of the different criteria that you want to use to evaluate whether a stock is good for a covered call. It kind of depends on where it is in the chart. Like, of course, you don't want to buy something at the top. You want to target the bottom where you can, but you want to look at some other things too. Like you want to find stocks that have at least 1 million shares traded a day. So you want something that's got liquidity. You also want a stock that is between about like 10 and 20 bucks. I've found that the higher, especially if you're going to sell puts and you have to lock up that kind of cash, buying something like Apple at $100 or a couple $100 a share or whatever, like, I mean, yeah, you can get a lot of time premium from 1 or 2 contracts, but that's a lot of money to tie up. So what you're trying to do is you're trying to kind of triangulate, if you will, the different variables, and you're trying to maximize your time premium return. So how you do that is you pick the stocks that can have decent wild swings, and that keeps your implied volatility up. So when you're selling an option, like you're selling a put or you're selling selling a call, you get more money per contract. And I've found that a lot of stocks between like that $10 to $20 mark, I actually think they return a little bit more per contract than something like a larger ticket item, like let's say you're selling a put on Apple stock or something like that. Yes, it has a lot to do with delta and implied volatility and open interest and stuff like that. But for the most part, I think that if you kind of target like the middle tier segment, like the mid market, not necessarily like small caps. I'm talking about like let's say a $300 million company sort of thing where it's not going to go under right away. I mean, you're not going to get any money if it goes bankrupt. But then again, you're not really owning shares unless you're selling calls. But you also want to pick something that might return some dividends, right? Like that's sweet. So for example, what we're looking for is some high dividend stocks, like let's say AT&T. They have a reliable dividend. What is it, 7%, something like that? That's pretty nice. So not only are you making time premium by selling calls and selling puts and stuff, but if you actually own the stock, you get the dividend as well. So you get the dividend plus time premium, which is pretty nice. We haven't really seen that yet, but I want to look at some stocks here that I think will be some good ads, just because I want to show people like the variety of stuff you can do with it. So I might, like, not AT&T, but I might buy like Carl Icahn, his fund is his fund's been getting beat up big time, and they're down a lot. So it might be time to start selling some puts or something like that, where let's say we do buy some shares eventually, they get assigned, or we buy some shares when they're low and then sell some calls against it too. We can also get that dividend. So they pay a dividend once a month, and it could be a pretty nice dividend. So it's like, if you have 2 out of 3, what Meatloaf said, right? That ain't bad. So if you have a lot of, your $1 million or your million shares worth traded a day, it's between 10 and 20, that's, you've already got 2 boxes checked for that. You also want to look for something that, if you're using that trade lab modeling, or, any like the option strat software that Chris is talking about, that's something too that you can use to see, like, what is the implied volatility, and is there a time horizon? Like, is it, let's say, 130% on next week, and is it only 15% 3 weeks from now, that kind of thing. Another thing too is that when you're going to sell an option, you don't really want to give yourself, or you don't really want to give out more than, let's say, like 3 weeks worth in the future. Because that's really when that time decay starts to accelerate, and that's where you're going to make a lot of money if you just hold on to it through that 3-week time period. Like I used to do probably like every 2 weeks, because that's when time premium starts to decay, big time. But 3 weeks out, if you're not really sure what's going to happen with the price, but 2 weeks out, I'd say if you're being aggressive about it and there's a lot of volatility, especially if you're looking at the implied volatility curve and it's still pretty high for the next 2 or 3 weeks. You're trying to target, what you're going to get the most bang for with your buck, because you can always close the trade and reopen it, right? That's the best thing about trading, is that, we're not buy and hold people for the most part. This strategy is more about actively managing it, but it's fun because you're making money as you're selling time to other people, and you're also holding shares. So it's like you have the possibility of getting dividend income, time premium from the options, share appreciation. So there's 3 different avenues here to profit from this sort of strategy, except if you sell cash secured puts, which you won't get that dividend income. Does that make sense? So pretty much, I think the less risky way to do this is to do the covered calls. I mean, cash secured puts are nice, but we're at that time in the market where we're not quite sure. Is it going to roll over? Is it going to shoot up to the moon again? And that's really what we're trying to cover right now, is we're trying to make sure that we're not just, selling a bunch of puts, and, that strategy would have been great, a year and a half ago, and then just keep rolling with it. But now maybe selling covered calls is a better idea, because you also get that dividend income. And if you want to buy some more conservative stock to try to, weather an upcoming storm, like, there's just tons of options for you. So hopefully that makes sense. And that's kind of really what I had on my itinerary here, to kind of go through like the major pieces of it. But this really hasn't been designed to like sell you on the strategy. I'm not selling anything. Well, what I'm trying to do though, is try to give you guys a little bit of perspective on, there's a million ways to skin a cat, right? And you can trade ETFs, you can trade just options, you can buy naked calls, naked puts. That's dangerous. We can talk about like option spreads and like debit spreads, credit spreads in the future. But for now, I think the covered calls is like a great way to kind of get your toe into the water, and just kind of see what it's all about, and give yourself enough time to learn what the Greeks mean. What's a good opportunity or when is a good time to sell a call, when's a good time to sell a put, that kind of thing. To skew towards your rules. And I think you'll have a decent time selling a stock. And the last thing I'll say about it is, I think I mentioned Tilray before. I tried an exam, or I tried. It's actually for my father, who was skeptical of the whole strategy. So I kept a log for an entire year of just that one stock and how many calls and stuff I sold against it. The stock actually ended up declining 50% that entire year. So my shares got whacked, but we sold enough premium where I actually ended up with a profit, or a net profit, on Tilray for the entire year. So knowing what you guys know about ETFs now and compounding, what a smart investor would have done is, if you really like the stock and you're really passionate about it, you would take that premium that you've earned and kind of, keep buying shares with it, because then you're accelerating that. You're growing that pile of shares that you can write calls against. So again, you need 100 shares each time. But again, if the price goes from $7 to 3.5, hey, awesome, right? You can buy double the shares with your time premium. You can just keep the ball rolling with that. And that's I've seen people do that with their entire portfolio, their entire strategy, and they'll triple their portfolio in 10 years doing it. And it's slow but steady, but it actually ends up working pretty good mathematically, especially in a highly volatile market. So yeah, that's pretty much what I had on my list here. I got time for questions and things like that if you guys have.
Yeah, Gaines, I had a question. Can you hear me?
Yeah, go ahead.
Yeah. I got email after I bought the 3 quantum computing stocks. I got an email from my broker Schwab saying that they were interested in entering a program like loaning them those stocks so people could buy them. Is that something that, have you ever done that, or?
Yeah, it's a good question. I'm not sure how they're making money off of that. I don't really know.
They paid me. They said they would pay me to do it. I don't know how much, but
yeah, I think you can do it on Robinhood too, where you could they'll loan out your shares. I don't really see. I guess if you can still write calls against it, then that's probably fine. But if you can't, then I'd say you can make a lot more money selling calls than loaning out your shares at probably only a couple of points, per 1,000 or $100 or whatever. You know what I mean?
Mm-hmm.
Hopefully that makes sense.
Yeah, I'll find out.
Yeah, if you'd let us know what happens with that, I'd be interested to know, because I've been asked about that too, and I'm just like, I don't have enough time to figure this out right now.
Yeah, I know. Thank you.
I know you got questions, guys. I know I didn't explain that well.
With a few of these, especially with like the quantum computing stocks, if we didn't put the whole position on at the time that you did, I would imagine the structure of the trade you had in mind could change pretty quickly. Like if I were to go and look at the spreadsheet right now, you might not necessarily put the same, you might not necessarily sell the same calls you would have sold a day or two ago. Is that safe to say? So maybe if I follow on a trade, but it's a couple days later of this nature, maybe it's best to like check with you about how to enter it into it today, as opposed to like a couple days ago.
Yeah, absolutely. Yeah, if you want to post something like in discussion or whatever, because I'm sure other people will probably have the same question. I always like to encourage that, just because if I can't get to it, maybe somebody else can answer it quickly or whatever. But you're totally correct. Every day changes, right? So I might pick a different strike, that kind of thing. And it actually kind of reminds me, if you pick a strike that's really close to where it's trading today, you'll get more time premium for that as well, because you're selling either like an at the money put or like a slightly out of the money, or sorry, not put. You're selling like a at the money or like slightly out of the money sort of call.
Right.
There are some people who like to live dangerously and will sell at the money calls for stocks that they own, just in order to get probably like another 20% per contract. But the risk of your shares getting called away is, I guess it's all in the eye of the beholder, right? So if you want to own those shares for a long time because you're trying to capture dividend income, that's probably not the best idea. But if you're trying to do the wheel strategy, which is you don't actually want to own any shares, you just want to sell puts against it and then write calls, like you're just using the shares as a vehicle to capture premium. Then your strategy changes a little bit. But
if you had shares that maybe you've held for a while and already had pretty significant capital gains on, and I really didn't care if it was called away from you at the current price, like that might be something you can do. Yep.
You can, and again, there's lots of different ways. Like I wanted to hold the Tilray stock the entire year, not just for the experiment, but also because if you're making like capital gains on them, well, I mean, in this case it was losses, but still, it's like, some of that can offset your capital gains and your options, because options are, I think it's 35% short-term capital gains, like no matter what. But it's worth it if you can make a pile of money, right? So like, there's no guarantee, of course, but if you can, then it's it's not so bad. It's better than having a, oh, sorry, I got alerts going off. It's better than having a, sorry, one second. Let me get this out of here. I got all my alerts loud here. All right. Sorry about that. Oh yeah. So the last thought I have on that is, I like to try to pick maybe like $1 or $2, a strike price over the current price if we're going to sell a call. So, like yesterday, I sent the charts and I said we're kind of at a wave 4 top right now. Assuming that it's, we're not done yet with the wave down, that's a great place to sell a call. But as you saw today, like they still went up a little bit. So the strike price I would pick would still be a little bit higher than the way sold it at yesterday. But that's, it's all hindsight, right? So you can't necessarily anticipate that, oh, maybe it's not a, maybe not, excuse me, maybe it's not a wave 5, maybe it's a ABC instead. It's going to go up to 50% instead of, that kind of thing. So hopefully I answered your question.
Yeah. Yep. It definitely did.
Okay. Great. Helpful. Good feedback. What else you guys got? You got something?
I got it all yesterday. I'm making money.
Okay. So, yeah, so I guess, I still want to make myself available for any questions that you guys might have with anything, options related. I'm still going to kind of stick to the basics with that. And like I said before, I will have a write-up for you guys. I'm working on it. It's about halfway done. I'm intending it to be like a Seeking Alpha article. So I'm trying not to screw it up, I guess. So on top of that, what we did cover really was, the Greeks all influence the price of an option. There's different strategies here where, there are some people that like to live a little bit more dangerously, where you sell, at the money, puts and calls or whatever, or, let's say you buy a whole bunch of puts because you think the market's going to crash, and you buy them at like 90 delta, it costs you 30 grand. And, and the market stays exactly where it is for the next 30 days. You've lost a lot of money just by decay. So there's risk associated with that, but that's really more like spreads and things. So we're kind of pushing that off till later. But like just calls in general, really, I think the key points are, make sure that you've picked a couple stocks that are, I'd say you want a little bit of volatility, but you also don't want stocks that are consolidating, because then it's kind of dead money. You want to try to kind of triangulate, like you want to buy a stock that's trending up. You want something that's got a little bit of volatility, and it's also trading at 1 million shares or higher, and it's within a good price range. You don't want to buy. You really shouldn't do options on penny stocks or stocks that are less than like a couple of bucks. Above 5 is probably fine, but those are the stocks that are a little bit more risky, just to speculate with, just in general. So other than that, I guess it's probably clear as mud for everybody. So.
What's your take on selling, for example? And I think you touched on it earlier, that it's not just, this isn't just a strategy selling, particularly selling covered calls. This isn't a strategy for the wheel and these things here. This is something that you can do with any equity that you own. If you have 100 shares of anything, it's an opportunity to make a couple extra bucks for holding those. Now, when and if I'm out of all the equities, the only thing I'm doing is day trading and doing this on a weekly basis. I don't really have any long-term. I'm very bearish. When the day comes, when we're loaded up on SQQ and SPXS and all the leveraged EFTs, what's the thought on selling covered calls on the leveraged EFTs, particularly because they have a higher volatility? They have a higher volatility, you're going to get better premium on those. Is there any rules for or against that because they're leveraged vehicles?
There are no rules against that. And in fact, I would I don't know if I could say I encourage it. But okay, so no, I mean, it's a great question, and you actually kind of, I think you're reading my mind here. It's a little weird, Chris. I'm kidding, but Chris is a great point. So I think I did it like a couple weeks ago, where I just sold a couple of calls when it kind of looked like market was going to go up and bounce. But he's right. So not every single ETF or every every stock actually has the ability to buy options, and most often it's the ones that are only a couple bucks, which is kind of why I said, try to stay away from them a little bit. But if you have something like SQQQ or SPXS, what you could do is you could sell calls against that when it looks like, let's say we're bottoming, but you're still really underwater. So let's take the gains portfolio. Okay, I mean, I've been carrying these damn shorts for forever, and it's been irritating, but at the same time, you can still profit as you're waiting, and selling calls against that. It would have been a pretty profitable strategy, but I didn't really want to do that, as we were still just trying to focus on ETFs. I wanted to try to at least, because I didn't do it doesn't necessarily mean it wasn't a good idea. It is a good idea, and I should have been doing it the whole time, but I didn't want to convolute what we were trying to do with equities and whatnot. And some of it kind of feels like micromanagement, but I guess you just got to kind of ask yourself, how much time do you have to manage these things? If you just have a handful of positions that you've sold, calls and, sold calls against, it's a lot easier to manage as opposed to 50 stocks, because you do have to look and do your homework on it. You can get a lot more money if you're patient and you pick the right time horizons, you do the right research and see, okay, this implied volatility is fine, or it's high, that kind of thing. So you're just trying to scratch off the 6 or 7 criteria that you really want to target for these sort of stocks. One thing I've done is, if you guys have TradingView, is the stock screener. I have a saved covered call sort of stock screener. I don't know. I don't think I can share it, but if you go into the stock screener and you pick out okay, shares greater than 1 million traded per day, you know what I mean? Kind of type in some of those parameters, price between 10 and 20, you can get a whole list of stocks. And what I've done also is filter out the ones that pay high dividends, and then you can kind of, stack rank them. So what I've been doing today is, since the market was relatively quiet, I went through, I had a covered call list, and I was just kind of going through a bunch of different stocks and trying to pick out, the next 2 or 3 that I wanted to either try selling puts against or whatever. And it's just something to give you guys something to do in your free time as you're researching the strategy. It's just that, to kind of bring it full circle, Chris is right. If you have these shorts and they're on fire at the moment, I mean, now is probably not the right time. I mean, I can see in the right-hand panel here, my eyes keep darting over here, and I keep seeing the Nasdaq selling off, which is great. But I would say a couple days ago, when it kind of looked like we were about to bounce, that'd be a great time to sell some calls if you have an inverse fund. And I think, some of the volatility there is advantageous for people that want to sell calls against it. So what Chris said, I mean, if anything, it might actually help to have a lot of that volatility, because it keeps the IV high, and you probably get some more time premium against it. And then you let the other people worry about the daily compounding, and people like me, I guess.
Right. And some people, I mean, instead of, if you think you're interested in a stock that you want to buy, don't buy it. Sell puts against it at a stock that you expect it to hit. So not only do you collect some of the premium, you got paid for buying the stock you were going to buy anyhow.
Bingo. Yep. So, and you'll also find too, if you do the math on it, you'll find that the time, or the premium, it can vary between $2 or $3, or sorry, buying the stock $2 or $3 less than what it's trading at today. So again, you compound it, right? So if you take that premium that you earn, and after 2 or 3 weeks, just put it in a bucket or whatever, and you keep selling more puts against it as you accumulate more of that capital by the stock. So, I mean, there was a stock I did that on for forever, and I think it was trading at $30 or whatever. And by the time I actually ended up buying it, I think it was at $18 or something, but I just kept selling puts against it. So it realistically ended up costing me $14 a share. So that's pretty nice, right? And I mean, it takes time, of course, like you can't be a millionaire overnight with something like that. But I would say if you're getting closer to like the end of your like career or something like that, where you want to be a little bit more conservative, but you still want to actively manage your own portfolio, covered calls is a great way to do it. It's, you know, like I said before, it's relatively low risk as long as you're smart about closing, as long as you're, you know, doing the right things, you know, buying in and out at the right times, you should be pretty solid with it. Any other thoughts, comments, concerns? Feedback? Gaines, get more to the point. I'm trying, guys, you know.
It was really good. No, this was great.
Great. Okay, good. I'm glad it was helpful. Any other suggestions for like future webinars and stuff? I mean, I just kind of threw this together haphazardly. I was chatting with Chris yesterday about it and thought it'd be good to share out for you guys. But I'm happy to, you know, keep the ball rolling if you guys want to talk more in the future about it.
Maybe, but yeah.
Okay. All right. Cool. All right, guys. We'll have a great. It's Thursday, right? Yeah, I think so. Yeah. Have a great day. And I'm kind of looking like we're getting a little bit of selling here, so that's promising for tomorrow. So hopefully, we got ourselves a nice retrace, and maybe the shorts won't be so over the barrel here.
Okay. Thanks,
All right, guys. Thanks a lot. Thanks for joining.
Thank you.
Talk to you later.
Bye.
Bye. Good
Bye.
luck.